Here's the part that should terrify anyone who's short silver or thinks this rally is overextended. According to Bullion, one of Singapore's leading precious metals dealers, the physical squeeze in silver is underpinned by years of structural deficits. Global mine production peaked around 2016 and has declined since then, while demand has continued to rise. And here's the critical detail that most analysts miss. Roughly 70% of silver is produced as a byproduct of base metal mining. That means higher silver prices alone cannot quickly bring new supply online. You can't just open a silver mine tomorrow because the price went up. The silver comes out of copper mines, lead mines, zinc mines, and those operations are optimized for the base metal, not the silver. Meanwhile, industrial demand now consumes more than half of annual silver supply, and much of this demand is highly inelastic. What does that mean? It means that electronics manufacturers, solar panel producers, electric vehicle companies, and artificial intelligence infrastructure developers need silver regardless of price. They're not going to stop building data centers because silver went up 20%. They're not going to halt electric vehicle production because silver got more expensive. They need the metal, and they're going to pay whatever it costs to get it. And unlike gold, which is mostly recycled and stays in circulation, much of the silver that goes into industrial applications is consumed and effectively removed from the market forever. Let's talk about what Morgan Stanley just dropped on the market, because this is where things get really interesting. Morgan Stanley raised its long-term outlook on gold this morning, forecasting that gold could reach $4,800 per ounce by the fourth quarter of 2026. But what's even more significant is what's happening with silver. Silver surged another 5% in a single day recently, pushing prices above $80 per ounce and extending the metal's powerful rally into early 2026. After gaining 147% last year, silver continues to outperform as investors pile into hard assets amid shifting rate expectations and tight supply. 147%. Let me say that again because I want it to sink in. Silver gained 147% in 2025. That's not a bull market. That's a historic repricing of an asset that was severely undervalued for decades. And according to multiple analysts, including some very bold forecasters, we might still be in the early stages of this move. Some analysts are now calling for silver prices between $135 and $309 per ounce. Now, I'm not going to sit here and tell you that $300 silver is guaranteed, but what I will tell you is that the fundamental case for dramatically higher silver prices is stronger today than it's been at any point in the last 50 years. Listen very carefully, because what I'm about to tell you is one of the most significant developments in the precious metals market in decades. And if you don't understand what's happening right now, you're going to miss the biggest wealth transfer opportunity of our generation. Right now, at this very moment, there are two completely different silver markets operating simultaneously on planet Earth. In one market, silver is trading at $73 per ounce. In the other market, that exact same ounce of silver is selling for $100. And no, this isn't a mistake. This isn't a temporary anomaly. This is a fundamental breakdown of the global silver market that's accelerating by the day. And the implications are absolutely staggering. Let me paint you a picture of what's actually happening on the ground right now. If you walk into a bullion dealer in Dubai, one of the world's major precious metals hubs, and you want to buy a 1-ounce silver coin, you're going to pay $99.93. Meanwhile, if you look at the COMEX March 2026 futures contract, which is supposed to represent the price of silver, it closed Friday at $72.26 per ounce. That's a $27.67 difference. That's not a premium. That's not a markup. That's a 40% disconnect between paper and physical markets. And it's screaming at us that something is fundamentally broken in the global silver pricing mechanism. But Dubai isn't alone. In Japan, physical silver premiums on secondary market platforms like Mercari have surged to 60% over spot price. 60%. Think about what that means. Japanese buyers are so desperate to get their hands on physical silver that they're willing to pay 60% more than what the paper market says silver is worth. In India, silver just crossed 250,000 rupees per kilogram. And even with a slight pullback today on January 10th, 2026, market participants are calling this profit booking, not a reversal of the trend. The physical metal is being valued dramatically higher than the paper contracts, and this divergence is accelerating. Now, I know what some of you are thinking. Premiums exist. Dealers have to make money. Shipping costs money. That's all true. But what we're seeing now goes far beyond normal market premiums. When you have a 40 to 60% spread between paper and physical prices across multiple continents, that's not premium. That's price discovery. The physical market is telling us that silver is actually worth significantly more than what the futures market suggests, and there's a very simple reason why. You can't build a solar panel with a COMEX futures contract. You can't manufacture a smartphone with a piece of paper that promises silver delivery. You need the actual metal, and the actual metal is becoming increasingly scarce. Now let's dig into exactly why this physical versus paper disconnect is happening and why it matters so much for your portfolio. The COMEX, which is the Chicago Mercantile Exchange, where silver futures are traded, has recently implemented massive margin hikes that are fundamentally changing the dynamics of the silver market. The initial margin on the 5,000-ounce silver contract has jumped from $20,000 to $25,000, and now to $32,500. That's a 62.5% increase in the capital required to hold a position. Francis Hunt, a well-respected metals analyst, points out that this margin increase took some of the sting out of thin markets by shaking out leveraged speculators and amplifying short-term volatility. But here's what the mainstream financial media isn't telling you. Forcing weak longs to liquidate does not create new ounces of physical silver. It doesn't magically make more metal appear in COMEX warehouses. And shorts, the people betting that silver prices will go down, are also facing higher margins and growing difficulty sourcing bar-sized metal anywhere near future settlement prices. Margin policy can thin participation and create short-term price volatility, but in a structurally tight physical market, it cannot reverse years of undersupply and overconsumption. Let's talk about China, because what China is doing right now with silver is absolutely critical to understanding where this market is headed. China has not banned silver exports outright, but they have reclassified silver as a strategic commodity. Think about what that means for a moment. The Chinese government, which is arguably the most forward-thinking government in the world when it comes to securing strategic resources, has looked at silver and said, this is not just another industrial metal. This is a strategic asset that we need to control. When the world's largest manufacturing economy and the world's second largest economy designate something as strategic, you better pay attention. The implications of China's move are profound and far-reaching. First, it signals to the market that China expects silver shortages and price increases. Governments don't classify commodities as strategic unless they believe supply constraints are coming and they want to secure domestic access. Second, it reduces the amount of silver available to the global market. Even if China doesn't impose a complete export ban, the reclassification creates friction, permits, delays, and uncertainty that will discourage exports. Third, it encourages domestic hoarding. When the government signals that something is strategic, Chinese citizens and businesses respond by accumulating that asset. We're already seeing the effects of China's policy shift in regional premiums. Physical silver is regarded as far more valuable in China than what Western paper prices currently reflect. In effect, the physical market in Asia is asserting price leadership over the paper market in New York and London. This is a massive shift in how global silver prices are discovered, and it's only accelerating. For decades, the price of silver was set in London and New York through paper trading on exchanges. But now, with China controlling an increasing share of physical supply and demand, the real price of silver is being discovered in Shanghai, not in Manhattan. Let's look at what Bullion is reporting from their Singapore operations, because this gives us real-time insight into physical market conditions. Bullion has experienced record-breaking demand for silver, and their current premium structure tells us everything we need to know about how tight the physical market has become. Good delivery, approximately 1,000-ounce silver bars are selling at spot plus 5.99%. 100-ounce, 5 kilogram, and 15 kilogram silver bars are selling at spot plus 10 to 12%. 1 kilogram silver bars are going for spot plus 14%, and 1 ounce silver coins are selling at spot plus 12%. Now compare those premiums to what they were just 2 years ago. In a normal market environment, premiums on 1 ounce silver coins might be 3 to 5% over spot. Today, they're 12% over spot, and that's at a dealer that prides itself on competitive pricing. In other parts of the world, as we've already discussed, premiums are 40 to 60% over spot. This tells us that the physical shortage is real, it's growing, and it's global. Here's something that most investors don't understand about silver that makes the current situation even more explosive. Industrial demand for silver is highly inelastic, and it's growing at double-digit rates in multiple sectors simultaneously. Solar energy accounts for 16% of global silver demand and has been growing at 14% per year for the past decade. Every single solar panel requires silver for the conductive pathways that allow electricity to flow. As the world transitions to renewable energy, silver demand from solar is going to continue accelerating regardless of price. The electric vehicle industry already accounts for 2.9% of global silver demand. Every EV requires significantly more silver than a traditional internal combustion engine vehicle because of all the electronics, sensors, and battery management systems. As EV adoption accelerates globally, this source of demand is going to multiply. Artificial intelligence infrastructure and data centers are emerging as a major new source of silver demand. Every AI chip, every server, every data center requires silver for connections and conductivity. The AI boom that everyone is talking about in the stock market is also a massive silver demand driver that most people haven't connected yet. Consumer electronics, medical devices, water purification systems, and countless other applications require silver because it has unique properties that cannot be easily substituted. Silver has the highest electrical conductivity of any element. It has the highest thermal conductivity of any metal. It has the highest optical reflectivity of any element. These aren't just nice features, these are physical properties that make silver irreplaceable in many applications. You can't just swap in copper or aluminum and expect the same performance. Now let's talk about the supply side of the equation because this is where the story gets really interesting and really frightening if you're short silver. As I mentioned earlier, global silver mine production peaked around 2016 and has been declining since then. But the reasons for this decline are structural, not cyclical, which means higher prices alone won't quickly fix the problem. Most silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. When a mining company is evaluating whether to develop a new copper mine, they're making that decision based primarily on copper economics, not silver economics. This creates a bizarre situation where silver prices can rise dramatically, but new silver supply doesn't respond quickly because the miners aren't primarily focused on silver. They're focused on the base metal, and silver is just a bonus that helps improve the overall economics of the project. This supply inelasticity is one of the key reasons why silver prices can move so violently. When demand increases, supply can't quickly respond, so all the adjustment has to happen through price. But there's another factor making the supply situation even tighter, and this is something that very few people in the mainstream financial media are discussing. Years of underinvestment in new mining projects are now coming home to roost. After the commodity crash of 2014 and 2015, mining companies cut exploration budgets, canceled development projects, and focused on returning cash to shareholders rather than investing in new production. That was the rational business decision at the time, but the consequence is that there's now a severe shortage of new projects in the pipeline. Even if a mining company wanted to bring new silver production online today, it would take years. You have to find the deposit, drill it out, do feasibility studies, get permits, arrange financing, build the infrastructure, and only then can you start producing metal. For a major mining project, this process typically takes 7 to 10 years from discovery to first production. That means the silver that's going to be produced in 2030 is determined by decisions that were made in 2020 or 2021. And during 2020 and 2021, very few companies were making those investments because silver was trading at $25 and the economics didn't work. Now, let's talk about what's happening in the ETF market because this is giving us some interesting signals about investor behavior. Total known global silver ETF holdings stood at 849.99 million ounces as of January 7th, 2026. That's down 2.4% from the cycle high of 871 million ounces reached on December 23rd. Some analysts are looking at this decline and saying it's bearish. They're saying that ETF outflows indicate investors are losing confidence in silver. But I think they're completely missing what's actually happening. The ETF outflows we're seeing are not necessarily bearish. In many cases, they represent investors rotating from paper silver to physical silver. Think about it this way. If you owned silver through an ETF when spot prices were $70, and you could sell those ETF shares and buy physical coins at $75 or $80, you might think that $5 to $10 premium isn't worth it. But if premiums are now $27 in Dubai and $30 to $40 in Japan, suddenly that ETF looks like a terrible deal. You're holding paper claims to silver when you could be holding actual metal, and the premium you'd have to pay to convert to physical is now so large that you are questioning whether your ETF shares actually represent what you think they represent. This rotation from paper to physical is extremely bullish for silver prices because it reduces the liquidity in the paper market while increasing demand in the physical market. Every ounce that moves from an ETF warehouse to a private investor's safe is an ounce that's been removed from the readily available supply that the market can access. And here's the kicker. That silver might not come back to the market for years or even decades. When investors buy physical silver during a bull market, they tend to hold it through the entire cycle because they're buying it as insurance, not as a trading vehicle. Let's examine the COMEX inventory situation because this is one of the most important indicators of physical market tightness. COMEX eligible silver inventory peaked at 342 million ounces on October 3rd, 2025. As of the latest data we have, it's down to 318.85 million ounces. That's a decline of 23.15 million ounces, or 6.85% from the peak. Now, 6.85% might not sound like a huge decline, but in the context of a market that's supposed to be in surplus according to many forecasts, it's actually quite significant. But the real story isn't just the total inventory level, it's the rate of deliveries. On January 6th alone, 1,624 units were delivered from COMEX warehouses, the highest single-day delivery since December 30th. This tells us that people are standing for delivery. They're not just rolling their contracts forward into the next month. They're not settling in cash. They're taking physical metal out of the COMEX system. Every delivery that stands is an ounce that leaves the exchange and goes into the hands of someone who wants to hold physical metal. Now, the COMEX can handle some level of deliveries. That's what the exchange is designed to do. But if deliveries accelerate beyond a certain point, it creates serious problems. The COMEX operates on a fractional reserve system, meaning there are far more paper claims to silver than there is actual physical silver in the warehouses. As long as most contract holders settle in cash or roll their contracts forward, the system works fine. But if a significant percentage of longs start demanding physical delivery, the exchange could face a serious squeeze. This is exactly what happened in the nickel market on the London Metal Exchange in 2022. A short squeeze developed, physical deliveries were demanded, and the exchange literally had to halt trading and cancel trades because they couldn't source enough physical metal to satisfy delivery demands. If something similar happens in silver, and I'm not saying it will, but the conditions are certainly aligning for it to be possible, you could see paper prices and physical prices diverge even further, and the scramble to acquire physical metal could send prices to levels that seem unimaginable today. Let's talk about lease rates, because this is one of the most underreported but critical indicators of physical market tightness. The 1-month silver lease rate has eased somewhat from the 7% plus levels we saw until recently, but it's still sitting at 4.46%. Now, to someone unfamiliar with precious metals markets, 4.46% might not sound alarming. But when you understand that the historical average for silver lease rates is 0.3 to 0.5%, you realize that current rates are roughly 10 times higher than normal. What does a lease rate tell us? It tells us the cost of borrowing silver for a specific period of time. When lease rates are high, it means there's strong demand to borrow physical metal, which usually indicates that there's a shortage of readily available silver in the market. Industrial users might be willing to pay high lease rates because they need silver to fulfill production orders and they can't source it elsewhere. Short sellers might be willing to pay high lease rates because they need to borrow silver to deliver against contracts they've sold. The fact that lease rates remain elevated at 10 times their historical average tells us that physical tightness is not a temporary phenomenon. This isn't a brief squeeze that's going to resolve itself in a few weeks. This is a structural shortage that is going to persist until either prices rise enough to significantly curtail demand, which seems unlikely given how inelastic industrial demand is, or until significant new supply comes online, which, as we've discussed, could take years. Now, I want to address something that a lot of silver investors are worried about right now. The market has pulled back slightly from its recent highs above $80, and there are people who are looking at this pullback and wondering if the rally is over. Let me be very clear about something. In a bull market, corrections are normal, healthy, and necessary. What we're seeing right now is likely profit-taking from traders who bought in the 60s or 70s and are happy to lock in gains. It's also related to the Bloomberg Commodity Index rebalancing that we discussed in previous videos, which is creating some mechanical selling pressure in the futures market. But here's what you need to understand. The fundamental case for higher silver prices has not changed one bit. The supply deficit still exists. Industrial demand is still growing. China's strategic commodity designation is still in effect. Physical premiums around the world are still at historic highs. COMEX inventories are still declining. Lease rates are still elevated. None of the bullish factors have gone away. What we're seeing is noise, not signal. And in a bull market, the best strategy is to buy the dips, not panic, and sell into them. Let me share some perspective on where we are in the silver bull market cycle. If you look at previous silver bull markets, they don't move in straight lines. The bull market from 2001 to 2011 saw silver rise from $4 to $49, but there were numerous corrections of 20 to 30% along the way. Traders who sold during those corrections and waited for lower prices often never got back in because silver would consolidate briefly and then surge to new highs. The same pattern is likely to play out in this bull market. Right now, if silver can hold support at the $70 level during this consolidation period, that would be incredibly bullish. It would mean that physical demand and long-term institutional buying is strong enough to absorb the mechanical selling from passive funds and profit-taking from short-term traders. If we break below 70, we could see a deeper correction to the $65 to $67 range, which would actually be healthy for the market and would likely attract significant buying interest from investors who missed the initial move. On the upside, if silver can break through and hold above $85, that would be a major technical breakout that could accelerate momentum and bring in trend-following algorithms and momentum traders. The $80 to $90 range is critical resistance, and once we clear that level convincingly, The next target zone would be $100 to $120. These aren't random predictions. They're based on technical analysis, prior resistance levels, Fibonacci extensions, and round number psychology. But let's talk about what really matters for long-term silver investors. If you're buying silver as insurance against currency devaluation, if you're buying it as a hedge against inflation, if you're buying it because you believe the monetary system is fundamentally broken and hard assets are the only safe haven, then these short-term price fluctuations should not concern you at all. What matters is the long-term trajectory, and the long-term trajectory for silver is clearly pointing higher. Some analysts are now forecasting silver prices of $135 to $309 per ounce. Bank of America mentioned that chronic deficits and massive bank paper shorts equal to 5.5 years of production could trigger a short squeeze that pushes silver toward $150 per ounce. Now, I am naturally skeptical of extreme price predictions because they make for great headlines but often don't materialize. However, when you look at the fundamentals, when you look at the supply-demand dynamics, when you look at the physical paper disconnect, it's not crazy to think that silver could trade at multiples of current prices over the next few years. Here's what I think is the most likely scenario. Silver consolidates in the $70 to $80 range for the next few weeks as the index rebalancing completes and weak hands are shaken out. Then, as we move into spring and summer of 2026, we see another leg higher that takes silver through $100 and potentially toward $125 to $150. The catalyst for this move could be a geopolitical event, a major default in the paper, silver market, China tightening export controls further, or simply the realization by mainstream investors that silver is dramatically undervalued relative to gold and other assets. But regardless of the exact path and timing, the direction is clear. Silver is in a structural bull market that is being driven by real supply shortages and real demand growth. This isn't speculation. This isn't hype. This is basic economics. When you have inelastic demand growth exceeding inelastic supply growth, prices have to rise until equilibrium is restored. And given how long it takes to bring new supply online, and given how many new sources of demand are emerging, that equilibrium price is significantly higher than where we are today. So what should you do with this information? That's ultimately up to you and your financial situation. But I'll tell you what I think. If you don't own any physical silver right now, you should seriously consider acquiring some. Not as a speculation, not as a trading vehicle, but as insurance and as a store of value. If you already own silver, these dips are opportunities to add to your position if you have capital available. And if you're sitting on large gains from buying silver at $20 or $30 or $40, congratulations. You were early to one of the biggest commodity moves of this decade. The silver market is sending clear and unmistakable signals to anyone who's paying attention. The disconnect between paper and physical prices, the record premiums in Dubai, Japan, and other markets, the COMEX inventory declines, the elevated lease rates, the Chinese strategic commodity designation, the Morgan Stanley forecasts. All of these signals are pointing in the same direction. We are witnessing a historic repricing of silver, and this repricing is far from over. The only question is whether you're going to be on the right side of this trade, or whether you're going to watch from the sidelines and regret not acting when the opportunity was right in front of you.